Now, it's interesting, moving on here a bit, that you made the point that the international aspects of the new law, the Tax Cuts and Jobs Act, and you made the point that by jobs, they mean jobs for accountants.
Yes.
Right? Possibly to a lesser extent, lawyers, full employment for accountants, yeah.
Absolutely.
That the international tax reforms do raise money. Did I understand that correctly?
Yeah, that's right. The international tax reforms are raising a total of $324 billion over 10 years.
Mm-hmm. And the international tax reforms clearly are for the benefit of corporations and overwhelmingly directed to corporations. Would you agree with that?
Yeah, well, the parts of the international tax reform that have costs are things like the dividend received deduction that corporations get for foreign source dividends. Well, that's only allowed to corporations, but the revenue raising parts of the international reforms, such as the transition tax to get Apple to bring its money back, those types of things are directed at everybody that owns some sort of foreign corporation, not just corporations.
Yeah, we'll certainly get to that in reasonable detail as we progress through this. But if somebody asked me, what happened with the new Tax Cuts and Jobs Act, I would simply say the Congress bent over backward to give benefits to corporations at the expense of individuals. Would you agree?
Absolutely. I saw it referred to as the Paying the Donors Tax Act.
I like that, the Paying the Donors Tax Act.
Yes.
But it's interesting that as I read the papers and that as the results of this are beginning to be understood. I mean, it's clear that there are at least some short-term costs for a number of corporations.
Certainly some short-term costs.
But the idea is they don't seem to be overly complaining about it because they're the return they're getting is that enormous tax cut. Okay, from 35 to 21%.
Plus the ability to bring any future foreign earnings over without it paying anything.
Right, or to put it, another way, so the United States has always had a system of worldwide taxation, meaning if you're a U.S. taxpayer, whether a corporation or individual, you've got to pay tax on your worldwide income, okay, meaning income earned anywhere in the world and specifically outside the United States. Now, here, what they have done in part, not as much as people are claiming, I think, but what they have done in part is created a certain kind of U.S. taxpayer, namely a corporation, and created provisions where some of their income earned outside the United States would not be subject to U.S. tax, but it has to be done in a very specific way. It has to be done by a U.S. corporation owning foreign subsidiary corporations. Have I got that right?
Yeah, that's how it is. So if you just are running your foreign operations through a branch, that's not what this is all about. And so expect to see more and more taxpayers organizing as domestic C corporations inside the U.S. with their foreign operations in corporations in the various countries where they do business. Exactly even right. A partnership that's running through international is not going to get a benefit of this.
That's right. So, to make this a little bit visual, so let's say somebody's reading the papers and say, oh my God, I just read that corporations don't have to pay tax sometimes on money they earn outside the United States. As far as I'm concerned, I'm in a business where most of the growth is outside of the United States. So the first thing you do is you run to your accountant and lawyer and say, God, how do I get in on the action? How do I get a piece of the action? So what's the first thing you would tell the person?
Well, you got to be careful a bit because it's not completely, it's not as black and white as it sounds. They've put in some base erosion and this global intangible low taxed income to make sure that they get something.
Sure, but the first thing you tell them is make yourself a corporation, right?
Oh, yeah. You're not going to get any benefit if you're not a corporation.
A U.S. corporation.
But even corporations aren't going to get 100% free foreign income. Not
because of the way they sort of redefined what foreign income is. All right, which is quite interesting. They've actually, in my view, restricted the definition of foreign income a good deal. So I think that a lot of things that maybe were foreign before, perhaps might not be foreign anymore. Would you agree?
Well, with the base erosion and the global low tax intangible income, yeah, that's what they're doing.
That's right. I mean, when I read it, it sort of reminded me of Ronald Reagan talking about his marriage. Where he said, well, when Nancy and I got married, we had an agreement that I'd make all the big decisions, and well, she'd make all the small decisions. And to date, we've never had a big decision. And it seems to me that it's going to be that people are going to have to be a lot more careful, okay, in defining, what really does meet the conditions of foreign income. But in any case, the point I think is this: that Congress has recognized that worldwide taxation is bad for U.S. corporations. They've created an opportunity, a template for U.S. corporations to not pay tax on some of their foreign income, provided that it's done properly. And, so you've got a tax rate going down to 21%. You've got the opportunity to have some of your income exempt from taxation. That's pretty cool, I would say. Would you agree? That is, if you're a corporation.
Oh, yeah, if you're a corporation. Like I said, for tax cuts for the donors.
Okay, exactly.